Welcome to Portfolio Manager Views. Today we're looking at private markets investing, and we're going to focus on infrastructure, an asset class that's playing an increasingly important role in our society, but also for investors today. My name is Colin Lynch. I'm a managing director, and I have the pleasure of leading our private markets group here at TD Asset Management. Today I'm joined by Danny Hong, who's the vice president and director on our infrastructure team. Welcome, Danny.
Pleased to be here. Thanks, Colin.
Excellent. Well, today we're going to take a look at infrastructure, and we're in a very dynamic environment overall, however, for the private markets. We know lots of stuff is happening in the world, geopolitical tensions, we see inflation, we've seen the impact in other areas in the private markets, whether it's real estate. Today we see a bit more focus on private credit, and I think the lesson has been you really have to look at the strategies in each of these markets to understand how they will perform, because they will perform differently depending on the risk. I think that's probably true for infrastructure, but infrastructure as well has been in a more stable environment, I would say, over the last 5 to 10 years. Perhaps add to that a little bit, help us get a sense of what the environment for infrastructure today looks like.
It's a dynamic environment for sure, Colin. So just looking back last year, we had the U.S. election, Tariff War, Liberation Day, policy changes in the U.S., including phasing out the Inflation Reduction Act. And that means volatility in the market. Despite that, infrastructure has continued to perform well in 2025. And looking into 2026, lots of geopolitical concerns, but infrastructure continues to deliver strong risk-adjusted return. So it's an asset class that we quite like.
And why has it really delivered those strong risk-adjusted returns? They're certainly very attractive to investors, but what has really propelled the ability of the asset class to do that?
Taking a step back, if we look at what infrastructure essentially means, it's real assets that have a physical component providing essential service to local communities. So think power generation in the form of traditional wind and solar, the transmission lines that deliver those electrons to the local communities, transportation in terms of airports, toll roads, marine ports, of how people move and get their goods on a daily basis, and also digital infrastructure relative to data centers, fiber optic networks, and cell towers of how we consume our digital content. These are real assets with a big physical footprint, often long-dated useful life with inflation-linked cash flow. And that's the stability in the infrastructure asset class.
You've mentioned a few different themes there. One of those themes over the past several years has been the energy transition. If you think about the big 3Ds, deglobalization, decarbonization, digitization, we also have domestic supply considerations and the like. Tell us how the last few months, if any, have really changed how you look at the asset class, or has it been really more of the same in terms of these themes have been there and we expect those themes to persist going forward?
There are a couple of things that are different and a couple of things that are still continues to be the same. Generally, there's still a lot of momentum behind infrastructure as an asset class and that continuation of stable return that's linked to inflation hedge cash flows. But I would say for very different reasons. And over the last couple of years, we have seen a lot of capital going into, call it aspirational goals under net zero or energy transition. That's been a good driver of infrastructure asset class growth over that same period. But looking forward, it's really the necessity that's driving the infrastructure growth. So think energy security, think supply chain resiliency, and future-proofing our infrastructure. So those are different drivers of infrastructure, but ultimately the same goal in terms of how infrastructure gets constructed, operated, delivered.
Interesting. So let's hit a little bit about the operation part. If you go all the way back to, call it the inception of institutional investors' interest in the asset class, we would think of it like assets. You buy a toll road operates and it produces some income. And I think the story is a bit more nuanced. In particular, there's the opportunity to create platforms and to scale those platforms and to drive the efficiency, the effectiveness, the growth of those platforms. Perhaps talk a little bit about that. Tell us why that's an important factor in the infrastructure return story.
Yeah, so relative to our infrastructure strategy, we're really attracted in investing in what we call platform companies. And what they are essentially is a pool of operating assets that's physical, already generating stable cash flow on a long term basis with that consistent yield component, but also with local management teams in place that can help go out, acquire newer assets, develop assets, oftentimes at a accretive rate to compound infrastructure return that's double digit on a long term basis. So platforms have operating assets, management expertise that's often local, technical, commercial, and then with that growth component of adding additional assets for attractive long-term risk-adjusted returns.
That's really cool, I think. So give us a sense of what you've accomplished by doing that, size and scale in terms of where you started and where you've built to today.
So one example would be our Silicon Ranch Corporation platform down in Nashville, Tennessee. This is actually our first investment in our infrastructure strategy back in 2014. When we first invested in this company, it's a solar operator and also developer down in the US, had about 50 megawatts of assets, and megawatt meaning that's the equivalent energy that's produced. Currently, the company has just north of 3 gigawatts of operating portfolio with another 4 gigawatts of pipeline coming in the coming years. So very substantial growth that we have experienced over the last 10 plus years. And the management team that's on the ground has a business plan to further that growth in the coming years.
Yeah, and so 50 megawatts to call it 3,000 of these megawatts today with another 4,000 to come. And then I think a megawatt is equivalent to, I think, 20,000 power
So
per
50 megawatts, for example, would be about 10,000 homes. And so 3 gigawatts is a substantial amount of power that can generate small cities.
Amazing. And then our portfolio has a lot of people actually at the portfolio companies running all of these different assets. How many people are doing this?
We have about 3,000, north of 3,000 management team operators on the ground across the globe, including Canada, the United States, and Western Europe. So really rely on the operators on the ground to further our agenda of operational excellence, the growth component, and delivering the infrastructure results that's good for the stakeholders, but also good for investors.
Amazing. So one of the themes that is talked about a lot today is AI and the growth of AI, the transformation of our society in many different respects for AI. And then, of course, people talk a lot about, as it relates to infrastructure, data centers. So perhaps give us some of your thoughts about that theme. How important are data centers in terms of infrastructure investors? Are there any risks that people should be considering as they look at the data centers? The broader concept of AI, what's the impact for infrastructure and infrastructure investors?
So AI is definitely here to say we have seen it make a big impact on our daily lives, whether that's work, personal, it's here to stay. Now, the question is, can you invest in AI and is that a reasonable investment? And that's a question that we ask ourselves on a daily basis. So what we have seen is there's a lot of high expectation relative to AI investments on the infrastructure side relating to data centers, potentially fiber networks with high growth assumptions. So oftentimes 20% growth on an annual basis for the next 20 years. And that may be true, but that's a very aggressive goal. So the approach that we have taken is really think about AI as a theme and how do we get exposure to that theme. So a couple example would be we have built infrastructure to enable the AI movements, meaning in the example of Silicon Ranch Corporation, they actually have signed 100 megawatts of power purchase agreement with Meta in South Carolina last August to provide power to their South Carolina data center. So that's kind of how we get exposure. In addition to that, we have a energy storage platform in Calgary, Alberta, that's building large-scale battery storage that can provide reliability and redundancy services to the grid so that they can go out and build additional data centers in the province of Alberta.
Really cool. Very interesting in terms of how one accesses transformational potential of AI, perhaps without exposing oneself necessarily to ambitious return assumptions. Very interesting world of infrastructure. If you to sum it up in terms of a couple things that folks should take away, what should they take away when they think about infrastructure investing in this world?
It's a volatile market, I would say. Strong risk-adjusted return in infrastructure, and that's particularly attractive in today's environment. Secondly, operating platforms that's generating consistent cash yield, that's often inflation-linked cash yield, with that growth component to achieve a double-digit return. So these three things is kind of the recipe on the TDAM side of how we deliver return over the last 10 plus years, and that's how I think investors should view this asset class. Now, maybe back to you, Colin. How do you think infrastructure fits into someone's portfolio as an asset allocator considering this asset class?
Yeah, look, that's a great question. I think it's an essential. It's an essential component of a portfolio. Why? A couple reasons. Number one, diversification. And that is something that many folks overlook at times, don't pay enough attention to, but is critical. Provide resiliency in terms of income over time for an entirety of a portfolio. So you do want assets, portfolio positions that do not trade exactly with each other to provide some degree of volatility reduction across the portfolio, first point. Second point is the really essential nature of infrastructure. We feel it if we don't have energy. We feel it if we aren't able to get our goods that we've ordered. We feel it if we aren't able to access the social infrastructure, the transportation infrastructure. So they're critical and need to remain operational. And for an investor, I think that's important to have exposure to assets, investments that play that foundationally important role in society. Because back to the first point, those assets need to, by and large, remain operational and produce the income that investors decide on. And then the third point, which is really in this order, more and more investors are realizing the importance of this, and more consumers are using the outputs from infrastructure. And so that provides some comfort that there will be continued growth in this asset class over time.
Great.
So it was a great way to turn the tables. Appreciate it, Danny. And it's a great way to conclude our time. So thank you for joining us.
Thank you, Colin.
And thank you for joining us today on Portfolio Manager Views. Please follow us on Apple, Spotify, Amazon, and YouTube, or visit us on the TD Asset Management site for more market insights.